Hey everyone, welcome back. So if you didn't watch the first video, in the first video we go over refining revenue assumptions and how we get the top line revenue. So we have revenue going from about 509 billion to 1.4 trillion RMB. So this goes from like 80 billion USD to 200 billion USD. Is my math right there? Yeah, 72 billion to 200 billion. So we walk through the assumptions here. High level, I think the takeaway is really for the big piece of the business is their China commerce retail, right? That's the big piece. We really tie that back to their GMV and look at some GMV projections and kind of the big assumption there is that the transition to e-commerce continues. So that's kind of the big thing. And then from there, we just make some high level assumptions kind of for the rest of the revenue lines. Cloud, we took a little look at, how big is this today in USD terms versus its competitors like Microsoft, Amazon, Google. And Microsoft, Amazon, Google are like 15 to 20 billion USD in revenue. And right now, Alibaba was at about 5 billion, I believe. So we have them growing to what seems like a pretty reasonable amount where they get up to about 30 billion USD by 2030, which I would assume at that point, kind of the large cloud players are, doubled, maybe tripled. So they're still behind the big ones, but definitely control the Asian market is kind of the idea there. So for this DMV or DMV for this DCF, I have not been to the DMV. I don't know why I said that. Anyways, um, revenue is straightforward. We link it off the income statement. If you look at COGS, you'll see there's a second piece in here off 20F info. So in their 20F, they actually break out stock-based compensation and where it goes kind of throughout the P&L. So here's the COGS portion, product development, sales and marketing, G&A, and then that gets you the total stock-based comp. So for the DCF itself, we've actually backed out. So if you follow this formula, the minus C50 on this 20F info, that's going to back out the stock comp, and that's going to do it for all three of these. And then the same thing for product development, sales and marketing, and then G&A. Now, they give us amortization of intangibles, so we back that out. Depreciation, they actually don't back out. They do give us some adjusted EBITDA calcs, and they don't actually back that out, which I thought was interesting. So they don't back that out, but then we get an adjusted EBITDA. And then obviously we're going to add back amortization of intangibles, stock-based comp, which is actually being removed from all of these so we can see the actual cost of these pieces. So we remove that. Depreciation, back that out so we can get an adjusted EBIT. Taxes, adjusted EBIT, and then obviously, basically we just add all the stuff back and then change for working capital, unlevered free cash flow. That's the high level model. The pieces in blue are the assumptions we need to make. So first, COGS as a percentage of sales. Right now we have it held flat to 2020. And you have to remember, this is excluding stock-based compensation. All of these are, because we've backed it out of these numbers up here, which I think is the appropriate way to forecast going forward. And then we can also make a separate assumption for stock-based compensation down here. So first, COGS is a percentage of sales. Right now we have it held flat. I think that this is probably not a fair assumption. I think that this is actually going to decrease over time. I know it's been increasing. I think a big piece of that is if we actually go back to their business lines, you'll see they have like this logistics service, which is new, which is probably expensive. Local customer consumer services is like same day delivery, so there's some COGS there. In some of their other stuff, where was it? Digital and media, they like brought a studio in-house and consolidated, so you probably have some studio production costs. So I think in the short term, right, they've seen it kind of go up just from these other layers being added in. But I think as this retail, the big driver of the retail is really advertising, which is a very healthy margin business. It's this customer management line actually. And then commissions is just that, it's a commission. And then others is actually mostly commission and then some other ancillary revenues as well. So I think over time, with the majority of their revenue, we have baked in coming from cloud and then really the commission business of their China consumer business. I think these go down over time as revenue grows. So I'm going to go ahead and do minus 1% a year. And I actually think it's probably not unrealistic to assume that they can eventually try to get back to where they were in 2018. And my thought here is in 2018, right, their total revenue was 250 billion, and of that, right, 176 was really from their core China, and the way we have it moving, we have it, not quite being as much, but it'll be about 2/3 of this. And actually, I mean, that's actually a pretty close percentage there. So I think over time, margins actually will go back towards that. And then the other big piece now is going to be cloud computing going forward, because some of these other businesses, while they'll grow, like there's only so much demand for like same day delivery of services. It's never going to grow into some crazy large business, most likely. Um, that's kind of like a premium offering. Some of these other things are really driven by membership fees. So like China Commerce Wholesale is really membership fee driven. And then same with international commerce wholesale is very, very much so driven by membership fees. Now, one thing to point out though, actually this other line does have direct product sales as well. So if we were to assume that this isn't mostly commissions from Tmall, which is what our current assumption is, if we assumed most of this was direct product sales, then maybe their margins don't ever quite get back to where they were, quite as healthy as they were. And we can see we actually have this growing faster, and that's just because we've seen actually incredible growth here, and it's been direct product sales and from the commissions on Tmall sales. So maybe we don't ever quite get back to this 41%, but I don't think it's unrealistic to think we'll get, hopefully land somewhere in the high 40s when you have a good mix between commission-based product sales and cloud computing. So maybe we actually just taper this off at about 46% there. Let's do that. So we'll taper that off. Product development percentage of sales, it looks like it's been a steady 6%. I see no reason to change that. Sales and marketing, 9%. No reason to change that. G&A, 4%. No reason to change that. Tax rate, this is an interesting one. The Chinese tax rate is 25%, but if you're classified as a high growth tech company, they'll give you 15%. In reality, this could probably be a mix, but it's not too impactful to the overall DCF per se. I mean, there's definitely an impact, but I'd rather overestimate taxes than underestimate, because at any point, I believe China can go in and probably change the tax rate pretty easily there, just based off how their government is set up. Capital expenditures, it's hovered 8, 9, 6. I've just left it at 6. You could put like 7 in here, right? If you wanted to, go in the middle. Why not? Intangible assets has hovered around, 4 and 3%. I just left it at 3%. Depreciation, obviously they had heavy investments for a while, and depreciation isn't catching up, so have that slowly increase to around 80%. So you have a good mix of growth CapEx versus maintenance CapEx, and that's kind of reflected in how much the depreciation is. Amortization of intangibles. So, part of me also thinks that maybe some of this depreciation amount and amortization of intangibles versus the split between CapEx and intangible asset acquisitions is getting a little bit skewed, because obviously the amortization as a percentage of intangibles is really high. So I've set this to 80%. In reality, there's probably something a little going on in their numbers, but when I pulled it out, it's kind of hard to really get necessarily a super good idea of what's happening there. So we'll leave that as is. Stock-based comp, right? I think 8, 10, 6%. So leave it around 7%. And then working capital is just a very simple, we're just leaving it as a net working capital turns. So I think high level, right? I think that this is probably pretty fair. If we assume just a little bit of COGS improvement as cloud business grows, and right now the cloud is not profitable based off their 20F, but over time the cloud business will be profitable, and I would like to think the margins on that will be very good. Once it's up and running, it's one of those things, once you have the data centers and everything built, once you get them full capacity, it just drives revenue and profit. So that's kind of the thought there. And then we can look here now at our valuation, right? So this is RMB, about 7.3 billion RMB. And in USD, that is about a $1 trillion company. So the exchange rate they give us in their 20F that they recommend using is 7.0808. So about a $1 trillion company. if we use the WACC of 6.84. So I have a video up where I calculate the WACC based off the WACC formula, and then for the cost of equity, use CAPM. I think the CAPM is just incredibly low at 7%. I think there's a lot of risk, to be completely honest, that's not being priced in. Well, I mean, it actually is being priced in. Don't get me wrong. They're trading at about 60% of this. They trade at 600 billion market cap. So the market is definitely pricing in more risk than a traditional WACC calculation would give you. So I think, something interesting, you could back in here what the market is kind of pricing, um, probably what, 9.25? And this is, right, 614, and this gives us 620. So, the market says 9.25 is probably a fair risk for this. Assuming, right, don't get me wrong, I'm not saying that this is what the market assumes the actual cost of equity is, or cost of capital. This is, if you believe my revenue projections, if you believe all my assumptions, right, you'd assign in 9.25%. In reality, I think the market is actually probably expecting much higher revenue growth. You know what I mean? They've been going from 50%, 30% down to 20%, and then just kind of like tapering off. The market probably has this going up to, 2 trillion RMB sales, so, or 2.1 trillion, right? Like 300 billion USD. And you can go into the income statement and you can adjust all these cells in blue and really get at some of that. Um, but I think if you truly don't believe that there is political risk involved in investing in Chinese companies that are listed through the VIE structure, if you don't think there's actual risk there, I think Alibaba is a buy all day, right? The question is, how real is that political risk in the VIE structure? And honestly, we see something similar. They had that just kind of materializes the risk in my mind, at least. They had, where did I take a note of this? Alibaba Health, growing, great little business they started up, you know, health services, delivering pharmaceuticals, telehealth kind of stuff. And they spun the company off for $1 billion USD, which is great, right? Don't get me wrong, that's phenomenal, right? $1 billion. And they got equity of Alibaba Health for it. Now, we saw something similar with Alipay a decade ago, or however long ago that was. And while 60%, yeah, like Alibaba got 60% equity, but you own a VIE that probably doesn't have an agreement signed with Alibaba Health when that was created. So now there's like this weird, yeah, they're consolidating part of the profits of Alibaba Health most likely into their financials, or maybe they're not. Who really owns the equity? Do you own it? No, because you own a VIE that owns a contract that owns a percentage of, all these sales of Taobao and Tmall and cloud computing, but you don't have a VIE saying you own anything in Alibaba Health, but Alibaba created Alibaba Health. So you know what I mean? It gets interesting quickly. And I guess what I'm trying to say is they can easily carve out businesses and just kind of say like, hey, you don't really get that. Like that stays with the actual shareholders of Alibaba. So now they have shares of Alibaba Health, but like those shares aren't tied back to the VIE. And I don't know about Alibaba Health. It may actually be tied back and they may be incorporating it in their financials. But if you own the underlying stock of a company and they spin it off and right, they create a new entity and they're like, for the spinoff, we're getting $1 billion worth of equity in this new entity. All the shareholders would split that equity evenly among themselves as they are kind of on like a pro rata basis of who owns the current shares, right? That's what would happen, and you'd get, right? You saw it a lot with a lot of the tobacco companies in, I want to say like the 80s and 90s and probably even the 2000s, but they buy a company, they spin something off, and even with like Sears, when Sears was spinning crap off under the hedge fund guy, um, that I think they took like, was it Craftman or something public, and when it went public, all the shareholders of Sears got a stake in Craftman, and you know what I mean, you actually got an equity stake in it. And this, like, yeah, they still own 60% of it, but do they, or are they just going to dilute it with Alibaba Health issuing new shares because they actually own all of Alibaba Health as the actual equity holders and the founders of Alibaba? It gets tricky quick. Is, I guess, the long way of what I'm trying to say here is I think the political risk is real. I think the structure is not easy to understand and fully wrap your head around. And I think there's definitely upside here. And I think is it Charlie Munger or whoever at Berkshire? I think he's a really big believer in Chinese companies, so he doesn't, necessarily maybe feel as scared of some of these things. And if we were to look at, like, let's see, does Berkshire hold? They might not hold Alibaba. 37 million stake in Alibaba. Actually, yes. So, um, right, and I mean for Berkshire, 37 million is nothing, right? Like I think their Apple position is like what 100 billion or something. Like, so 37 million is a very small bet for Berkshire Hathaway, but for a regular person, that's a pretty big bet. But if they're looking at this and they're like, look, I don't think the political risk is real, and I think this is really the next Amazon of China and Asia, and it's going to get there, and China's going to continue to explode in growth, right? It's very easy to say, like, yeah, the risk isn't really there. This is going to be a slam dunk. Um, so I think it's really wrapping your head around the political risk piece and understanding if you're comfortable with it. Because, right, if you throw, right, I would probably throw like a 12% whack on this. I'd be like, that's pretty risky company, I would think, 12, 13%. And then, you refine these and you say, China's actually growing like crazy. They're not going to slow down. Um, 10 years, this isn't going to be a mature company. It's still going to be growing in the teens, right? If you made those kind of assumptions, and here, real quick, let's just change this and we'll look at kind of what growth we can get if we just quickly hard code some values in here. That's fine. Delete those. Right, and if we say, look, they're going to grow 18% for the next, right, like China's growing. China's not slowing down anytime soon. We're just going to have them grow 18%. Right, even with a 13% discount, then you still get a pretty good value. And if you're like, they're not even that risky, 10%, right, all of a sudden, they're trading very, very under their fundamental value. Um, so, I mean, I think for me, I do more conservative valuations in that sense. And then, I guess with the more conservative valuation, you could say you're actually putting a lot of risk in there. So maybe you do something a little bit lower, right? And if you think that this is as risky as an Apple or an Amazon, an 8% risk, right? This company is undervalued by 50%. This could be a home run. Um, but I think it's that political risk that really scares a lot of people and keeps them from kind of really trading um, in line with kind of what like a fundamental aspect would show them trading at. And another thing is, right, I mean, their auditing and reporting things just aren't nearly as tight um, there as they are in the US, right? Like if you look at Luckin Coffee, right, a lot of fraud there. I don't think that that's the case with Alibaba, but to be honest, I don't know. So just another thing to think about. But yeah, I definitely think Alibaba is an interesting one, and I think if you're open to taking on political and foreign risk, it's probably a pretty good company. It looks like it's the leader in the category without a doubt, and kind of just following the footsteps of Google and Amazon combined, right? They have a big advertising business, and then they have a massive platform where they generate a lot of revenue as well. They have cloud, so I think it's a pretty interesting aspect from that standpoint. So thanks for tuning in. Love to hear your thoughts and comments. Leave them below, and thanks for watching.